All right, today we're going to pull back the curtain on something you don't normally get to see, a massive institutional trade in the gold market. Now, this isn't about predicting what's next. It's about understanding the playbook, the strategy the biggest players use to move billions of dollars. So let's get right into it.
So first, you've got to get the context. Picture this, it's 2025, and gold has just had its best year since 1979. It shot up almost 70%. The market is absolutely euphoric. We're hitting all-time highs, and pretty much everyone is bullish. It is the perfect picture of a runaway market.
But, and this is a big but, lurking just under all that excitement is a huge mechanical wave of selling pressure. See, because of a mandatory index rebalancing, a whole bunch of passive funds have to liquidate up to $6 billion worth of gold, and it's happening right now.
So this creates the classic dilemma, right? An unstoppable force meets an immovable object. What happens when a market, at its most bullish, driven by real-world fear, smacks headfirst into a multi-billion-dollar wall of forced selling? This is the puzzle every major trading desk on the planet is trying to solve.
Okay, so let's break down these two powerful, completely opposite forces that are about to collide on January 8th, 2026. This is where the story really gets good. On one side, you've got the bulls. There's military action in Venezuela, global tensions are high, and investors are doing what they always do in these situations. They're piling into gold for safety. But on the other side, you've got the bears, and their case has nothing to do with feelings or fear. It's just a technical rule, a rebalancing of the Bloomberg Commodity Index that says you must sell, period. It's pure fear versus pure mechanics.
And you know, for the big institutions, this isn't some amazing opportunity. They're actually calling it a technical calamity. I mean, think about their problem. How on earth do you sell $6 billion of an asset without causing the price to crash and completely wrecking your own position?
So how do they solve this puzzle? Well, they don't just hit the sell button. That would be a disaster. No, they need to find buyers, a lot of buyers. And to do that, they have to get clever. They engineer the perfect scenario, they build a trap.
So here's the fundamental issue. The goal, obviously, is to sell at these amazing all-time high prices. But the problem is, there just aren't enough natural buyers way up here. There's not enough liquidity, as they call it, to absorb a $6 billion sale. So if the buyers don't exist, they have to create them. And they know exactly where to find these potential buyers. They target something called buy-side liquidity, or BSL. Just think of it like a hidden reservoir of buy orders. These are placed by smaller traders who are betting that if the price breaks out to a new high, it's going to keep going. And all those orders are clustered right above key levels, like that big psychological number, $4,500.
And right here on the slide, this is the trap itself. It's often called a Judas swing, and it's like a three-act play. First, step 1, accumulation. They let the market get really quiet, build up some tension. Then comes step 2, manipulation. This is the key moment. They engineer a sudden, sharp spike in price to blast through that $4,500 level. It looks exactly like a massive breakout, and that triggers step 3, distribution. The second all those breakout traders' buy orders get triggered, the institutions hit the sell button and dump their entire $6 billion position into that buying frenzy that they just created.
And don't just take my word for it. This quote comes directly from an institutional report about the event. It says, the whole point of that move is to provide the necessary buy-side liquidity to fill their massive sell orders. It's not a random market move. They are literally manufacturing their own exit strategy.
Okay, let's get into the nitty-gritty and see how a plan like this is executed with almost surgical precision. This is the smart money playbook, laid out for us to see.
And what's just fascinating here is the level of detail. I mean, this isn't guesswork, it's a full-on battle plan. They've got a precise entry zone plan for after the trap has been sprung. They know exactly what price level proves their idea wrong, their invalidation point. And they have these crystal clear targets, ending up at what they call the value area high, basically a level where they believe the market will find its balance again. Now, here's a really critical point. These traders don't just blindly sell at the top. No way. They wait for confirmation. They have a checklist. First, they need to see that price spike we talked about to grab all that liquidity. Second, they need to see the price reverse so hard that it breaks a recent low, what they call a market structure shift. And finally, they don't chase the price down. They patiently wait for a small bounce back up to get the best entry. It's only when all three of these things happen that they get the green light. The heist is on.
But of course, no plan is ever foolproof, right? Even a meticulously planned $6 billion trade has a wild card, a scenario where this entire beautiful trap just completely falls apart.
And this slide really lays out the two very different ways this could go. The most likely scenario is that the trap works perfectly. The mechanical selling takes control, and the price heads down toward their target. But the wild card is if the geopolitical situation gets even worse. If a true state of emergency is declared, it could spark such a massive panic buying spree for gold that it completely swallows that entire $6 billion in selling and sends the price screaming higher.
So after going through this entire institutional playbook, what's the big takeaway here? Why does understanding this kind of maneuver actually matter to the rest of us?
I think the most important lesson is this. Market prices aren't always this pure reflection of supply and demand that we're taught about. At critical moments, at really key levels, price is actively engineered. Smart money doesn't just sit back and react to the market. They get in there and manipulate it to create the conditions they need to execute their plans.
And that really leaves us with a final question for you to think about. The next time you're watching the market, and you see a price that's hitting a new all-time high, and then it suddenly and violently reverses, what are you going to see? Will you see just a random, unpredictable price move? Or will you see the fingerprints of a plan, the anatomy of an institutional trap?